It happened again. Not because silver suddenly became worthless, not because demand collapsed overnight, and not because the world found a hidden mountain of new supply. Silver fell because the rules were changed while most people weren't looking. A margin hike hit the futures market, and it triggered forced selling, fast, mechanical, and brutal. If you were leveraged long, the market didn't ask for your opinion. It demanded cash. And if you didn't deliver immediately, your position was liquidated at whatever price was available. That is the entire event. Everything else you're hearing is noise. This is what actually happened, and in the next few minutes you're going to understand why this drop wasn't a mystery, why it wasn't a fundamental shift, and why the paper price can collapse even when the physical market barely flinches. Stay with me, because once you see the mechanics, you'll never read a silver chart the same way again. Quick note before we continue. If you want clear breakdowns when markets move suddenly and explanations that cut through panic headlines, make sure you're subscribed. No hype, just mechanics. Now let's get into it. A silver futures contract is not silver. It is a leveraged promise. One contract controls a massive amount of metal, but you don't pay for that metal up front. You post margin, a performance bond. It says you can handle volatility. The exchange decides how much that bond must be. And when volatility rises, the exchange can change the rules instantly. When margin requirements are raised, every leveraged account is recalculated at the new level. If your account no longer meets the requirement, you get a margin call. And here's the part people underestimate. Margin calls are not negotiations. If you can't post more collateral immediately, your broker closes the position for you at market prices. No patience, no discretion. Now multiply that across thousands of traders holding similar positions. This is where things get violent. The selling isn't driven by belief, it's driven by obligation. Traders aren't exiting because they think silver is overpriced. They're exiting because they're forced to. And forced selling does not look like normal price discovery. It looks like a cliff. That's why these drops feel sudden and shocking. There's no gradual back and forth, no testing of levels, no pause. The market falls until the forced sellers are gone. Then, and only then, does it stabilize. Timing makes this even worse. Margin hikes often land during thin liquidity periods when fewer participants are active. Thin liquidity means fewer bids. Fewer bids mean price gaps faster. Stops get triggered more easily. A cascade forms before most people even realize what's happening. This is the first critical lesson. In silver, you're not just trading the metal. You're trading the leverage structure built around it. Ignore that, and eventually the market will remind you. Let's slow this down and make it concrete. There are two margin numbers that matter: initial margin and maintenance margin. Initial margin is what you need to open and hold a position. Maintenance margin is the minimum balance required to keep it open. When volatility increases, exchanges raise both. And when they do, not everyone is affected equally. Large institutions can move collateral quickly. They have treasury desks, credit facilities, and instant liquidity. Smaller traders don't. Retail traders don't. Many accounts simply cannot wire new cash fast enough, especially around holidays or weekends when banking systems slow down. So who gets liquidated first? Not the biggest players, the least liquid ones. That's why these events feel unfair, because structurally they are. Here's how the chain reaction unfolds. Price dips. That dip triggers stop-loss orders. Stops become market sells. Market sells push price lower. Lower prices create more margin stress. More margin stress triggers more liquidation. The cycle feeds itself. Because futures represent enormous paper volume, this spiral can represent millions of ounces changing hands in minutes, even though no physical metal moved at all. This is how paper price can collapse, while the real-world supply-demand picture barely changes. It's not a contradiction. It's the design of the system. But structure has limits. When paper price falls far enough below physical reality, buyers with real cash step in. Arbitrage starts noticing the gap between futures prices and physical availability. This process isn't instant. Delivery rules, financing, and logistics slow it down, but the discount becomes irresistible to the people who actually need metal. This creates the central question after every margin flush. Did forced selling just hand discounted silver to buyers who don't care about leverage, charts, or sentiment, only ounces? Because if that's what happened, today's crash becomes tomorrow's problem for the shorts. This is why leverage is dangerous in silver. If your position doesn't have slack, it doesn't have time. You can be right on fundamentals and still get destroyed by mechanics. The market can force you out long before you're proven right. Now let's talk about intent without falling into conspiracy. Exchanges will tell you margin hikes are about risk control. And that's true. They need to protect against default when volatility rises. But risk control and price impact are not separate outcomes. They are the same action with different labels. Raising margin reduces buying power. It forces some positions to close. It changes order flow. It changes price. And silver has a long history of seeing this tool deployed at moments of maximum sensitivity. When price accelerates upward, margin rises. When leverage builds, rules tighten. The result is often the same. Longs are squeezed, momentum breaks, and the narrative flips from scarcity to speculation. Is that proof of manipulation? No, but it does highlight incentives. When rallies threaten large short positions, forced long liquidation offers relief. It creates cover. It buys time. No coordination is required. Just structure doing what structure does. Now look at today's move like an investigator, not a commentator. The key clue is speed. True fundamental shifts do not unfold in 15-minute avalanches. Mines don't triple output in an hour. Solar demand doesn't vanish between breakfast and lunch. Industrial users don't cancel contracts because of a candle. Paper can move that fast because paper is a claim. Claims can be created, dumped, and traded by algorithms at extreme speed. That's why futures prices can move violently while physical conditions barely change. And that's why you must separate the screen from the substance. During margin flushes, physical markets often behave very differently. Premiums hold, inventory tightens, dealers hesitate to cut prices. Sometimes premiums even rise as buyers rush in. If silver truly lost value overnight, physical sellers would compete to unload it. You'd see panic. Instead, you often see restraint. That divergence is a signal. It tells you this wasn't the world rejecting silver. It was leverage being purged. And purges, while painful, often reset the market. They transfer exposure from weak hands to strong hands, from traders with timers to buyers with patience. That doesn't guarantee a rally, but it does change who's left standing. This is where silver's history becomes a warning label. This pattern has repeated across decades. Price surges, leverage builds, rules tighten, forced liquidation hits, the rally breaks, and afterward, the story is rewritten as excess and speculation. But the mechanism is mechanical. Change the terms, force the exit. That's why the phrase, "it happened again," matters. Not as drama, but as a map. If you know the map, you stop being surprised by the terrain. And here's where the map leads next. If physical demand remains firm while paper price is shaken by leverage rules, the market begins to split. Paper trades fear, physical trades need. When that gap grows large enough, it demands resolution. Either paper prices rise to meet physical reality, or physical availability tightens until paper promises become uncomfortable to honor. Neither outcome is bearish for the metal itself, so don't let a margin memo rewrite the bigger picture in your head. Let it clarify the battlefield. Silver is not just a commodity. It's a stress test of trust, and every margin hike is an admission, quiet but real, that leverage, not metal, is the risk. To understand what happens next, you need to zoom out beyond the candle that caused the panic and look at who remains after the dust settles. Markets are not moved by events alone. They're moved by who is left holding risk after those events pass. A margin flush is not the end of a story. It's a sorting mechanism. After forced selling clears, the market is quieter, but it is also thinner. Many leveraged longs are gone, open interest drops, volatility contracts, and suddenly, price movements begin to matter again. Not because sentiment improved, but because the automatic sellers have been removed from the system. This is where many traders make a mistake. They assume the crash itself is the signal. In reality, the signal is what happens after the crash, when price stops falling, even though the headlines are still bearish. That's when you learn whether the drop was distribution or transfer. Distribution looks like sustained weakness. Every bounce is sold. Physical demand fades. Premiums soften. Inventory builds. Transfer looks different. Bounces hold. Physical buyers quietly absorb supply. And paper sellers struggle to push price much lower, even with negative sentiment on their side. Which environment are we in now? You don't answer that by staring at a 5-minute chart. You answer it by watching behavior. Watch how quickly price stabilized after the forced liquidation. Watch whether dealers aggressively discount or quietly wait. Watch whether delivery demand changes. These are slow signals, but they matter far more than the first violent move. Another critical piece people overlook is positioning before the margin hike. Leverage doesn't build evenly, it clusters. When price accelerates, momentum traders pile in late, using maximum leverage because they feel urgency. Those are the weakest hands in the market. They don't have conviction, they have exposure. When margin rises, that exposure becomes fatal. This means the flush disproportionately removes recent buyers, not long-term holders. The narrative flips, but the underlying ownership changes in a way that can actually strengthen the base. Think of it like an overloaded bridge. Removing weight doesn't destroy the bridge, it keeps it from collapsing. Now let's talk about shorts, because this is where misunderstanding explodes. A falling price does not automatically mean shorts are winning. Shorts profit when they can close positions lower than they opened them. During a forced liquidation, price may fall, but liquidity becomes chaotic. Spreads widen. Execution quality deteriorates. Not every short gets the exit they want. More importantly, margin hikes don't discriminate. Shorts face higher requirements too. If volatility spikes enough, shorts can be stressed as well, especially if price snaps back. This is why margin flushes sometimes create violent reversals. Once forced selling ends, there's no one left to sell aggressively. Meanwhile, shorts who pressed late suddenly realize they're exposed in a market with reduced liquidity. That's when you see the move nobody expected, but reversals don't announce themselves, they build quietly. Another layer here is hedging. Many industrial users hedge price risk using futures. When price drops sharply, some hedges are adjusted or removed. That changes flow. At the same time, producers may reduce forward selling if prices fall too quickly. That also changes flow. So the paper market is constantly rebalancing positions that have nothing to do with speculation or sentiment. These adjustments can absorb selling without fanfare. This complexity is why simple explanations fail. Silver crashed because demand fell sounds neat, but it ignores the machinery. Markets are systems, and systems don't move for single reasons. Now consider psychology. After a sudden drop, fear dominates. Social feeds fill with certainty. Everyone explains the move after it happens. Confidence rises precisely when understanding is lowest. This is when people make the worst decisions. They sell because price fell, not because the structure changed. They abandon positions without checking whether the reason they bought still exists. They mistake volatility for information. Volatility is not information. It is motion. Information is what remains true after motion stops. Ask yourself simple questions. Did industrial usage vanish? Did investment demand structurally reverse? Did supply meaningfully increase? Or did leverage just get punished? If the answer points to mechanics, not fundamentals, then the drop is not a verdict. It's a process, and processes can repeat in reverse. One of the most misunderstood ideas in silver is that price must always reflect scarcity. In reality, price reflects marginal trades, and marginal trades in futures are often driven by leverage, not need. This is why silver can be scarce and cheap at the same time, not because scarcity isn't real, but because the marginal price setter is not the marginal consumer. When that disconnect grows extreme, it creates instability. Something eventually gives. Sometimes paper snaps back. Sometimes physical markets tighten until paper prices are forced to respond. Sometimes rules change again, but equilibrium is always pursued. That's why silver feels frustrating. It doesn't move in smooth narratives. It lurches between regimes. Understanding that doesn't make volatility comfortable, but it makes it navigable. Another point that deserves clarity is inventory. Headlines love to say inventory is high or inventory is low without context. Inventory in registered warehouses is not the same as freely available supply. Much of it is spoken for, pledged, or already earmarked for delivery. During margin events, inventory numbers don't suddenly change. What changes is willingness to offer metal at current prices. Sellers step back, buyers step in quietly. That's why you often don't see inventory collapse during these events. The stress is expressed through premiums and delays, not warehouse counts. Now let's address the claim that silver is too volatile to be a serious asset. Volatility is not a flaw. It's a feature of a market where leverage, industrial demand, and monetary narratives collide. Gold is mostly monetary. Copper is mostly industrial. Silver sits uncomfortably between them. That makes it unstable and powerful. When monetary demand rises, silver responds. And when industrial demand rises, silver responds. When leverage builds, silver reacts violently. That combination makes it difficult to manage, but also uniquely sensitive. Margin hikes are attempts to tame that sensitivity. They slow momentum. They reduce exposure. They force discipline. But discipline imposed externally doesn't eliminate demand. It just delays its expression. So when you see a sharp move driven by rule changes, don't ask, is silver broken? Ask, who just got removed from the market? Because the answer to that question tells you far more about what comes next than any headline. We're not done yet. There's one more layer that ties all of this together, and it's the one most people miss when emotions run high. The final layer is time. Markets punish impatience more reliably than they punish ignorance. Margin hikes weaponize time against leveraged traders. They compress decision windows until only those with immediate liquidity survive. That is not an accident of design. It is the design. Silver exposes this more clearly than almost any other market. Because it is small relative to global capital, flows matter. Because it is heavily leveraged on paper, rule changes matter. And because physical supplies cannot respond quickly, dislocations matter. When time pressure is applied, truth is revealed. Not about value, but about positioning. Look carefully at who is hurt most by these events. It's rarely the entities that actually consume silver. It's not electronics manufacturers. It's not solar producers. It's not mints planning months ahead. It's traders whose exposure exceeded their resilience. That distinction matters. Because when the weak exposure is removed, the remaining market reflects something closer to reality. Not perfect reality. Markets never do. But a truer balance between promise and possession. This is why experienced participants don't panic during margin flushes. They watch. They let the mechanical phase run its course. They understand that forced selling ends not when fear peaks, but when obligations are satisfied. And obligations always end. The moment liquidation finishes, the market shifts from automatic to intentional. Every trade after that point is a choice, not a requirement. That's when price action becomes meaningful again. So what should you take from all of this? First, understand that price drops driven by rule changes are not judgments on value. They are stress events. They test structure, not substance. Second, recognize that leverage is not neutral. It amplifies upside, but it shortens time. If you don't control your time horizon, the market will control it for you. Third, stop confusing motion with meaning. Fast moves feel important, but importance is revealed in what persists after speed fades. And finally, remember that silver has never been a simple market. It has always been a battleground between paper efficiency and physical necessity. Margin hikes are just one of the tools that tilt the battlefield temporarily. They do not rewrite the long game. If silver were truly losing relevance, it wouldn't require constant rule adjustments to manage its volatility. The very need for intervention tells you something important. Pressure exists, and pressure doesn't disappear. It relocates. So the next time you see a sudden drop, don't ask what headline caused it. Ask what rule changed. Ask who was forced out. Ask who is left. Because markets don't move on stories. They move on structure. And when you understand the structure, you stop being surprised by the outcome. If this breakdown helped you see the move differently, you know what to do. And if you think margin-driven flushes are done forever, ask yourself one last question. If silver really wasn't a problem, why do the rules keep changing? That question is where the real analysis begins.